moving on swiftly to a talk on the future of finance, clearly an ambitious topic, very related to all the topics we've already heard about this morning. Dr. Peter Kurer is going to address it and I'm sure make it very interesting. His background, well, he was trained as a lawyer. He joined the bar in Zurich in 1980. He worked for Baker & McKenzie and Homburger, famous law firms, one international, one more local, specializing in M&A and corporate finance and corporate law. He was also on a number of boards of public and private companies. He joined UBS as general counsel in 2001. In 2008, he ended up being elected chairman at UBS. Today, he is a partner in private equity firm BLR and Partners, focusing on investments, advising on corporate finance transaction, corporate governance, and acting as an independent advisor. Let's welcome Dr. Kurer.
Thank you, Jerome, for the kind introduction. Good afternoon, ladies and gentlemen. It is a great pleasure that I'm here in the core of Switzerland. I have not brought a Swiss flag with me. You will see my presentation is much more on the global and the international level, and few things are addressed directly to Switzerland. Actually, I've been asked to talk about the future, and this obviously leads to two challenges for me. The first one is it's still time after the lunch, and I don't know whether your stomach still allows your mind or already allows your mind to turn to the future. And the second one is that obviously I do not hold the crystal ball. Nobody holds the crystal ball, and I think the finance industry has not been a master in telling the future more recently. The Danish philosopher Kierkegaard once said, "Life can only be understood backward, but we have to live it forward." And this is exactly the situation of the finance industry today. We all live with the legacy of the past, the crisis. You have seen it in many presentations here. The environment is generally not very good and conducive for business in general, and more particularly the finance industry, and very often is plainly adverse. However, we have a mission to forge and plan our future now. And this future, I reckon, will be very different from the past. Let me explain this thesis in terms of 5 relatively simple propositions. The first one is the crisis is not over. Markets have been quite favorably in recent times because we have the easy money. The interest rates are nailed down to the floor. However, this is mainly driven by the policies and the politics of the central banks. None of the structural problems, by contrast, of the financial world and the world economy at large have been really solved. The leverage in the system is still high. It moved somewhat from the private area to the public area, to the governments. The economic imbalances have corrected here and there, but by and large, they are still very dominating. And already new bubbles are building up. This was or is the 5th anniversary of the Lehman collapse, and we have all read the editorials and the essays and what have you on this collapse. If there is one single consensus of these editorials and these articles, is it will not be too long before we will see another Lehman event. And this is obviously a very sobering and saddening conclusion. My second thesis or proposition is that many of the financial markets are dysfunctional as a consequence of the crisis. After the crisis, the governments basically focused to fix the bad banks. We have seen some of the regulations and policies which they introduced. They have not looked at the broader picture of the finance industry, and they have not looked at the unintended consequences. And in particular, they have overlooked that many financial and capital markets are now broken and have become dysfunctional. I'm not a macro guy, I'm not an economist, but I wander around in the world and talk to a lot of people. And let me give an example on a particular market which is broken, and this is cross-border lending. I recently, 2 years ago, I was in Ukraine, and I sat down with a friend of mine who runs a chain of restaurants, very innovative restaurants. And he had an idea for a new one, and he went to his bank and asked for a loan, a relatively small loan, to support his new venture. The bank said, we are very pleased to do this, and then he asked, what is the interest rate? They said 18%. So obviously this was the end of his venture. I was very puzzled about this, and I made a little survey amongst some other friends in the Central Eastern Europe area, and invariably the answer was a similar loan would be 15, 16, 17, 18%. I've recently gone back to the Ukraine and asked my friend whether the whole thing has gotten better, and he said, no, now I have to pay 22% on the same loan. Now, what is the reason for this? The reason is that these are countries which have no functional domestic banking system. They have many banks, but they're all special interest banks. They have no strong lending banks. This gap was filled for many years by foreign, mainly Austrian banks, some Italian, some German banks, which went into the so-called cross-border lending. And then came the crisis and the increased capital requirements, which we have seen in the last presentation. At the same time, which forced these guys to reduce their lending, and at the same time they obviously got the call from the finance ministry that they better do that not domestically, do not hurt the domestic economy, but rather should do that in the cross-border lending. So they withdrew all this money, obviously with very damaging effects. The CEE was for many years the most dynamic emerging market in the whole world, growing at a very high pace, and it is now a disaster. And the region will struggle to go back to this dynamic growth. This cross-border situation in CEE is not an isolated situation. The IIF has recently estimated that cross-border capital flows have decreased by 60% since 2007. More general, to expand this example, the transformation in the finance industry does not work. We see in many places, not here in Switzerland, so-called credit crunches. A credit crunch is if the banks do not lend sufficiently, if the businesses do not get loans sufficiently. So with other words, the easy money produced by the central bankers do not end up where it should end up, namely in the real economy. Rather, this easy money is used to create and feed new bubbles. Look at England. In England, there is clearly credit crunch, and it's a big problem for the economy. But at the same time, we already see a bubble in the mortgage markets. So the easy money goes into the mortgage market, consumption rather than into the real economy. I could go on with many similar examples of broken situations and dysfunctional markets, but save for the time, and therefore I only will list a few of them. In many bond markets, there is no sufficient liquidity. And when you have listened to David, you see the reasons. He has said, you are on your own. That means not sufficient liquidity. Infrastructure finance has become a very serious problem around the world. There are very few players left, and the monoline insurers which supported these markets, they are all gone as a consequence of the crisis. M&A is far away from its pre-crisis level. We see here and there very huge transactions and many smaller ones, but overall the numbers are considerably below pre-crisis level. And we see, if you look into the landscape, growing up a whole generation of new CEOs of large companies who never have made a major deal in their life. So this is a complete change. Private equity is probably somewhat better, but very patchy. It's good in some places, and it's not so good in other. And venture capital, which would be extremely important to support innovation and to bring innovation into real businesses, is very weak. It's very difficult to find funds to support ventures. The costs of these broken situations obviously are very high, and I believe deeply that this is one of the main reasons why we do not see the world going back to a real growth path. And it would be necessary that the policymakers would take a broader approach to this and a better policy mix to mend this. My third thesis is legal and political risks are the new challenge. The English consulting company PA Consulting recently conducted a survey of 205 senior executives from different quarters, not just the financial industry. They asked them about the source of their main concerns and their main uncertainties. Political and legal risks scored highest, both in terms of impact and level of uncertainties, well ahead of economic, technological, and social risks. There are a number of reasons for this. The first one is obviously globalization, which is a longer trend. When you go global, you go into more countries, you multiply your legal risks. A second one, extremely interesting sociological fact, is the sensitivity for risks has gone up. Global businesses, and that means not only banks, it means drug companies, oil companies, steel producers, create risk. And the public and the politic gets more sensitive to these risks, and they retaliate. And this retaliation creates then the legal and compliance and political risks for businesses. Today, worldwide, it is estimated that in developed countries, developed economies, 10% of the GDP is invested into compliance. This is not compliance alone for financial industry. It's, you know, the oil spill, the drug, etc. 10%, that's almost as much as into health. The second one is the concept, or the third reason is the concept of the strong government. The many years of globalization has pushed the idea of deregulation. And it has also advanced and furthered the idea of democracy. The number of countries which lived under a democratic regime, plus minus, has gone up constantly. The crisis has reversed this trend. The strong governments are on the rise, and democracy is in retreat. Look at the Economist Democracy Index. The number of people living under democratic regime is going down. And large parts, and very important parts in economic terms of the world, are in the hands of authoritarian governments or failing governments. Take China, Russia, or the Middle East. And on top of this, some democracies countries which are clear democracies and have a rule of law resort to what I call quasi-authoritarian behavior vis-à-vis business. A good example is the US under the Obama administration. The next reason for this trend of growing legal risk is growing regulatory fragmentation. That's basically what Patrick Rafflaut this morning has described. He called it de-internationalization. I call it fragmentation. You all have read or heard at least of Tom Friedman's famous book on globalization, The World is Flat. I have to confess, for me as a lawyer, the world was never flat. It was always hilly, and there was a lot of different legal regimes. But it gets clearly hillier in terms of regulatory systems since the crisis. The reason is very simple. Governments are elected locally. They legislate locally to please their local constituency. As a result, banks and many other businesses have to cope with growing fragmentation. Just look for a good example at the fights between the US and the EU on many or almost all aspects of banking regulation, capital or ring fencing concepts. Now, many people describe this as a legacy of the crisis. This is foolish. This high level of legal risks is here to stay. And businesses have simply to cope with it. And you have heard, I think, in the presentation of Luke Ellis how his approach to this is. And that's, I think, the sober approach you have to take. Now, this was, to go back to my quote of Kierkegaard, the past, the sins of the past, in a sense. Now, let's have a look at the future. My fourth proposition is the new paradigm of the finance industry is what I call unbundling of financial services. The time of the large financial conglomerates is over. All players will focus more on particular businesses, get more flexible, and concentrate on core competencies. You have heard it recurrently. You heard it in the presentation of Joachim Jäger this morning, David Sloan's before me. The reason for this development is very, very simple. If legal risks and political risks and other risks go up, then focused companies can be better managed in a difficult environment. They can react faster to changes and have a clearer picture of the sort of risks which they are facing. We have seen as an example the big Swiss banks considerably reducing their operations. And day by day, we see in this new, nimbler world, new players entering the space and financing forms taking place which we have not seen. Parabanks, crowdfunding, direct lending by investors to businesses, and so on. My fifth and final proposition is we will see industrialization and independent advice as new dominating force of operations and delivery. Unbundling is the structural change taking place in the industry. There is a second paradigm shift, in my view, which is the form of operation, how businesses are operated, and how they deliver the services to the clients. Here I see two megatrends. The first one is industrialization and increased use of technology. Customers today want more for less. They want better products at lower costs. They want to have more transparent and simpler products very often. This will force the providers to resort to more industrialization and a better use of technology and more efficient system. And this applies from the front to the back. Many systems are still fragmented, if not outdated. This will change and has to change. We see it already in many places. More and better e-banking, more and better financial apps, more and better financial information systems, more compliance and legal risk management supported by technology. The second mega trend in this area is unbundling of advice and sale of products. The financial service industry is still full of people who are both salesmen but dress themselves up as advisors. We see it in all markets, in wholesale, in retail, wealth management, asset management. This will change and has changed for a number of reasons. First, a growing number of clients simply no longer believe that your car dealer is also your car advisor, and they will apply this thinking to the financial industry. Second, the combination advisor-salesman gets more and more risky in regulatory terms, and you experience that every day. And thirdly, with increasing transparency and better financial information systems, better financial apps, the dominance of the big platforms in terms of intimate knowledge of the markets is decreasing. So this brings me to my summary. The finance industry definitively lives now in a difficult environment. It's low growth of real economy, in particular in Europe, higher regulatory burden, higher political and legal risks. The industry will adapt to this, no doubt. By unbundling, it will organize itself into smaller, more focused and more flexible players. And it will improve systems and technology. And it will separate advice from sale. This is, in my opinion, the future of finance. This future has already started, as this conference proves. Actually, I think this future is already in full swing. And with this optimistic note, I thank you for your attention.
That was a very deep and very interesting view of not just what's happening in the financial world, but also the political world. Certainly a lot of that resonates with what I think. Do we have any questions from the audience? One at the front, please. Where's my running microphone? Ah, there, please.
With the unbundling of the large financial organizations, obviously this will vary. A reinsurance organization is going to be quite large and quite global. But if you take it to certain of the financial sectors, where do you think it will end? Somewhere between a boutique, maybe focused on one country, one regulator, and something that's maybe more regional, say focused on Asia Pacific, or maybe global ex-USA, as an example.
Yeah, I think we will see all sort of things. Certainly what I do not mean is that we will not have big players. There are reasons you need a few big players. Where will it end up? I think, first of all, it will end up in a landscape of many more specialized providers, which will be extremely focused on one product, which they can explain very well, which is transparent. You have heard a lot by Luke Ellis, or the reverse thing where these two balloons by Saxon-Anhalt, where you have seen how the whole thing has escaped. When it comes to the geographic footprint, which is your question, we will see everything. We will see a few global players, and amongst the global players we will see kind of full service guys, and we will see highly specialized expert firms, what I call SCFs. Then we will see regional players. I gave you the example of the CEE, this region can only come back if it has viable, strong regional players. You know, if the Austrian banks, which are good banks, and the Italian banks can go back and play a role there. Otherwise, with their small specialist banks, which are in the hands of a few oligarchs, they never will bring the economies back. So we will see regional solutions. However, there are only a few regions in the world which are open for this. So, Switzerland is not a region, it doesn't belong to a region, it's on its own. But there are regions like the Nordic states, Central Eastern Europe, which I mentioned, then you have Southeast Asia, you have the Middle Americas, and so there are very few of these where we will see strong regional players. And then we will see boutiques, you know, many firms like you guys here, who will have global networks normally, very well connected, go to a lot of conferences and know where to fix things on the other side of the globe. That's what I call boutiques. And then you will see national champions like, you know, the British Main Street banks and these things, or some of the players here. So that, I think that's the landscape I see geographically.
Okay, thank you. I think we're a little bit tight for time, so Dr. Peter Kurer, thank you very much. That was very insightful. Thank you.